He's live? Awesome. Dillard, could I have you up on the stage, please? Sorry. Yeah. Hello, everybody.
Hello. Howdy.
I know it seems like I'm being a little rigid, but we have about 120 people online, so welcome everybody online. Thank you for being here, so we're going to try to start on time. Anyway, thank you very much for being here. I know you guys hear this from me a lot, but all of you are beautiful people. I love to see you every single month. And we're going to have some special guests for you tonight. I'll introduce them here in a minute. Because how many of you are tired of just hearing me talk? Okay, 2 people anyway are honest. 2 people are honest. I'm going to introduce everybody here in a minute. But Darwin is here tonight. He'll talk to us as well. So let me kind of give you an idea what tonight is going to be like. Again, we know you've got other places you could be on a Tuesday night. So thank you very much for coming and sharing it with us. We feel like we've got important information that we want to impart to you. Tonight is going to be a little bit different from the DGRE meetings that we've been having in 2021, and that normally and typically we focus on investment opportunities and about all of those benefits, right? Tonight we're going to talk about, this is probably geared a little bit more for the existing partners. So the first thing I'm going to ask is, raise your hand if this is your first time here. In this building? Yeah, but you're not a newbie. Okay. We would love an opportunity to get to meet those of you who are first-time guests with us. We've got Julian and Garrett here from my investor relations team, and I'd love to shake your hand and just thank you for coming. But normally, while we focus on investment opportunities, tonight we're going to talk about something that is very important to the vast majority of you because you are partners on the properties. So tonight is going to be more operational talk. Okay? I get a lot of calls recently in that, well, how's it going with eviction moratoriums? How are you dealing with it? Phil's an example. Phil will always ask me. Phil always sends me emails saying, I think you can kick them out for this. Okay? Unfortunately, Phil, I got to follow the law and fair housing. But anyway, feedback is always appreciated. I just like to pick on Phil. But thank everybody for being here. But tonight is going to focus more on operational. Okay? We're going to talk about primarily, and I said this already, but welcome everybody. And I'm going to do the agenda, then I'm going to introduce everybody. But tonight we're primarily going to talk about, again, from an operational standpoint, Texas rent relief. Everybody know what that is? If not, you're going to become very educated on it tonight. Eviction moratoriums, financial accounting and distribution process. What is that? I know everybody in here is interested in the distribution process, right? You want those mailbox money checks? URI insurance claim. Does anybody know what URI is? I didn't know it either until, you know? That's exactly right. Did you all know that the winter storm had a name? I didn't know that. Our insurance company educated me on that just a few weeks ago. Said, when you call, we would appreciate if you refer to your URI claim. What is that? They've named the winter storm URI. And then we're going to talk about, just some operational challenges. It doesn't mean anything that we can't overcome. In fact, we like to brag about the fact that we are going to overcome them and do them anyway. But we do want you, this is intended really to give you kind of an update on what happens at the property, some of the things that we're dealing with from a big picture standpoint, from an operational standpoint. It is not meant to be a property by property review. I am proud to say that we have 19 properties. If we just spent 2 to 3 minutes on every property, you would be here for a long time. So we're not going to do a property by property review. However, I will stay as long as you want. Vicki will stay as long as you want. Dillard will stay as long as you want. Our team will stay as long as you want. After the fact, if you want to ask specific questions about a property, but that's not really what tonight's geared for. We're just going to talk about big picture stuff, and we'll be glad to answer any of those other questions for you as we go. So having said that, we will have let me do a couple of house cleaning things. For those of you who haven't been here before in this building, haven't been here. The restrooms, if you need to go to the restroom or make an exit, please go out the back door right there next to Darwin, and then go out the door. The restrooms are just to your left, and you have to have a code to get in. It is 521 enter, okay? I'll tell you real quickly, everybody seems to enjoy this story. Several people ask me, why do you have codes on your bathrooms? Does anybody know? You've heard the story before, right? Okay. Number one, it's on there for women for security reasons. Number two, the men's restroom did not have it when we moved in, but we quickly learned, because there are some times where some of us are here till 11, 12 o'clock at night, and we couldn't understand why our parking lot was filling up with 18-wheelers. What is going on? Are they just using us as a parking lot? I don't know. Then they started coming in, and I'm going out and asking them, what the heck is going on? What are you doing? The guy just admitted to me, you have a reputation, this building has a reputation for having the cleanest bathrooms from X to X, from exit X to exit X. And we get on the CB radio and we share that information. So by the way, it's been that way for years, which now explains to me why we had a night crew coming in on Monday, and on Tuesday morning, it's still a wreck in the restroom. And I was getting on to them, saying, you're not cleaning really well. What's going on here? No, we did not rename it to Buc-ee's, but good point. We did not rename it to Buc-ee's. So I put again, I'm not trying to be mean to the truckers. I'm not trying to be mean to the traffic, but we just can't handle all that traffic, okay? Our plumbing issues have gone down dramatically, Darwin, since we put the codes on the door. So, let me introduce some people before we start. Ben, would you stand up at the back? Ben, just raise your hand. Ben Mandelstein. Ben is, if you do not know, Ben is our co-sponsor on Village Condos, aka the Brazos. I say every meeting, it's the last time I'm going to call it Village Condos, but every time I introduce him, I feel like we've got to do that. Just sitting to Ben's right is a guy named Darwin. His name's on the building, so probably doesn't need any introduction. Garrett, raise your hand. Garrett Stroud, part of our investor relations team. Julian's here somewhere. I'm not sure where Julian is. Anand, would you stand up, please, or just hold your hand up? Anand Depadier is our co-sponsor at Southwest and doing an awesome job at Southwest property for those who may be invested in Southwest. Let me go ahead and start here. Dillard Stone. I don't know where to start with Dillard. There you go. Dillard does, and I'm going to ask him to talk a little bit about tonight about what he does. So I'm not going to steal his thunder, but Dillard is our controller, okay? Some people call him the accountant, some people call him stick in the mud, some people call him whatever, but Dillard makes sure that all the transactions that happen on all properties and at DoorCorp, all across the entire portfolio, are done correctly and or fixed. I think that's the best way to put it. Vicki Skidmore, many of you probably know Vicki. She's not new to our team, but Vicki is Director of Property Management. So all of the properties eventually roll up underneath Vicki. She's got a regional manager that reports to her, Jessica Hammerbeck. Many of you may not have met her yet. She's been to one meeting, but due to medical reasons, she couldn't be here tonight. So she sends her regrets, but she couldn't be here tonight. But again, they're going to help between the three of us and between our team. We're hoping to give you an overall kind of an operational picture on what's going on with the properties from a top-level standpoint. When we get done, Darwin's going to come up and make some announcements. And again, this is just some updates in regards to Brookside and Crossing. And then we'll have a Q&A, and that's where you can ask any and all questions. There's nothing off limits. Darwin used to say, and I'm actually, so last time I'm going to say this, Darwin, because I don't even like it when you say it. We talk about sharing the good, the bad, and the ugly. Anybody know who Darrell Royal is? Darrell Royal said, I don't throw the football because 3 things can happen and 2 of them are bad. I don't like the good, bad, and the ugly because that means that 2 things out of 3 are bad. So anyway, we're just trying to be transparent and open and honest with everything that we do. So we'll have a Q&A session with the entire team and answer any questions that you might have. So without further ado, let's get started. Okay. I get the, Jessica was going to cover this tonight, and I'm going to brag on Jessica for a minute. Jessica's only been with us since February 10th of this year. Right, I mean, literally the week before the storm hit. We had big, high hopes for Jessica on what she was going to focus on. That soon changed when, not because of the storm, but it changed when Texas rent relief was announced. And I'm just going to give you a little bit of background. The Texas rent relief was created by the Texas Department of Housing and Community Affairs to help renters with expenses as far back as March 13th, 2020. Okay? Renters are eligible for past due, current, and up to 2 months in the future of both rent and utility expenses. All payments are made to the landlord. That's the way it was supposed to be. That's the way it was supposed to be. All payments are made to the landlord or the utility provider unless we do not agree to accept the payment. Does anybody think we're not accepting to agree to payment? No, we'll gladly accept the payment. Application started as of February 15, 2021. What I'm going to talk about tonight is not necessarily specifically just the Texas Rent Relief Program, which we lovingly call TRR, but it's any kind of assistance, whether it be Catholic charities, whether it be, again, we've got a laundry list of about 12 different charities that we feed our residents to and say, hey, we think they'll help you, we think they'll help you. We're just trying to do everything we possibly can for them to go get help somewhere else so that what? They can pay us, right? Okay. I assure you, there has not been one instance where we did not agree to accept the payment. So with that, I'd like to share with you Texas rent relief assistance and what it means to each of our properties to date. Remember I said the application started February 15th. We really did not start getting money or the first part of the money until April timeframe. By the time you do the applications, they go through the process of being approved. Then you got to verify it. It's a long, drawn-out process. The reason I'm going to brag a little bit about Jessica is because this became such an important deal to us. And I can tell you, we had somewhere between $1.3 and $1.6 million that had not been paid to us because of COVID-related issues. Okay? So we felt like this was really, really important for us to. So Vicki and I talked about it. We assigned Jessica. You do nothing but focus on Texas rent relief. I got to give her some kudos. She did about 3 weeks worth of work. She sent it all into the state of Texas, and like most government programs, it didn't work right. They sent us an email and said, thank you for your work. You were very proactive. Start over.
There's a new website.
Start over. We didn't have everything set up right, and everything you've loaded may or may not have gotten to us, but we can't really tell you if it got to us or not. You can choose to just move on with what you want to do and hope that we got it, or you can start the process over and ensure that we start this process over. Anyway, rest assured we started the process over, so despite all the frustration, she started over and started the entire process again. I'd like to tell you too what it takes. It's not as easy as us sending something to the state that says, Mr. Smith owes us $10,000. We can apply, we can provide the information. That information then has to be verified with whom? The resident. They have to sign off on it. So it kind of created a kind of a challenging relationship. These are the same people that for a year refused to pay us. Would you please help us help you? Okay? Does that make sense? You can kind of see, for the most part, we convinced almost everybody, not everybody. There's always some stubborn people that, yes, it's in my best interest. So bottom line is, we have to provide the information. They have to verify the information. They have to sign off on the information that we're then sending. They then get an email from the state that said, are these people lying, or do you really live there? And are you verifying all the information that you've already verified, that they say you verified, that we sent to you? We need your verification. Sound like an Abbott Costello routine. Government entity. Anyway, long story short, this is as of July 31st. So we still have what we believe is probably in the neighborhood of $150,000 to $250,000 that's still coming, because what happened is at the end of the process they said, okay, that's it, no more applications. As soon as they said that, they came back and said, oh, we didn't spend all the money. There's still a bunch of money out there. The government's giving us more money. Now you can go ask for another 3 months worth of future help if you want to, if you can justify it. Keep in mind kind of the timeline here, because it's a little bit challenging for us. We were certainly playing very, very nice with the residents. Why? Because we needed them to verify the information with us. Because remember, they're sending the money directly to us. Play nice with us. We play nice with you. We're no longer going through the eviction process. We'll play nice. You play nice. Everybody play nice, like we were in kindergarten, remember? And then our plan was that, okay, we're going to play nice until we get the money. Then the next time you miss a payment, guess what? We're starting this process all over again, and we're going to file eviction. And we actually started that process to start eviction. And then the state came back and said, oh, we got more money. Try it again. Okay. So now we're going back to these same people that we tried to evict again. Hey, help us help you. We're trying to get more money. So we're still in that process. Again, this is not a woe is me or woe is us. I just want you to understand kind of what the process is. Amber Vista, to date, has received over $75,000 in Texas rent relief money or assistance money. So just think about that when you get your financials. That's all income that would not have been there without Texas rent relief program, so kudos to them for coming up with it. But really, I'm going to brag on Jessica and our property staff because they're the ones who had to knock on the door, sit down with them. They may speak English, they may not, 10 different languages that we had to go through, and I mean, it's a chore. So I'm bragging on Jessica and the staff that was able to go out and get this done. Brookside, almost $111,000. Crossing, a little over $17,000. Frankfurt Station, easily $26,000. Again, we've only had that for, 3 months? Gold Creek, $19,000. Oakview, $21,000. Does anybody kind of see a trend here? It is certainly not going to be a surprise to you that our higher class properties tend to have a lower, because that tenant base did not have as much trouble adjusting and adapting to the COVID environment. We call it workforce housing, but the people that inhabit these properties were probably more able to just stay at home and work from home and continue their job, whereas most of the demographic from some of the other properties were hit harder and could not actually go to their job and didn't have a job they could do from home. So anyway, let's look at Parkside, almost 40, a little over $46,000. Ridgemar, $58,000. Riverbend, $75,000. Silver Creek, $192,000, what we were able to get. And we're not done. Southwest, almost $100,000 on them. Awesome, you and your staff. 1019, got to brag on her because she doesn't have any delinquency. She doesn't let them.
That was one person.
Yeah, and that was one person. One person. The Brazos, Ben, sorry, but we didn't have that property. We only had it for a couple of months, and the manager there just does not. I'm not going to pay you is not an option for that manager. So $500. No delinquencies. That's right. The Corners, a little over $50,000. Village Oaks, $57,000. 2405 at Park Row, $6,200. Valley Center, it's not eligible for business people, so don't even try. Holly 90 and Kainani, none. 0. Okay? The other thing I want to point out too is that, again, not only can you see a trend in the demographics. Oops, I just shared that. Now you already know my secret. So, anyway, what does all that add up to? What does it mean for the Dark Horse portfolio? The only other point I'd like to make about this is that many of these properties are new properties to us. The Brazos, how long have we had that? 3 months, 4 months, sorry. Corners, we've only had that for 7 months. Village Oaks, 6.5 months. You know about Valley Center and Kainani. Let me back up just a little bit because I do want to make a point here. Where's the one I'm looking for? Okay, Oakview, we've only had it for 6 months. Frankfurt Station, 2.5 months. I mean, the point I'm trying to make here is that a lot of this was not trying to absolve us of responsibility, but a lot of this on a lot of these properties, or half these properties, are problems that we inherited when we bought the property. Okay, we feel like we've adapted a little bit better now. We're not going to let it get into this situation ever again. And we'll talk about some of the challenges that we've had in regard to the eviction moratoriums. We'll talk about that in a little bit. But what does all that add up to? $872,810.78. And I'll tell you, that's a little bit low, simply because the money was coming in so fast from Texas Rent Relief in the early month of April that it took us a couple of weeks to say, whoa, wait a minute, the fire hose opened up. And we, not that we didn't deposit the money, we did deposit the money, but we realized very quickly that we needed to create a different code, an income code, thank you Dillard and Vicki, different income code just so we could track this. Because if we just put it in income, you'd never know what our success rate was or lack of success. So anyway, Texas Rent Relief and or assistance, almost $875,000 to date. Like I said, we probably expect, if what they say is true and they're going to do just another 3 months of it, we would probably expect another $150,000 to $200,000 out of that. So put us right around the $1 million mark. But again, great kudos to the staff, to Vicki and Dillard for processing all this, to Jessica for all the work. And again, Jessica would be the first one to tell you, this is the property manager, this is the assistant manager, this is the maintenance people, these are the leasing agents that are making this difference, because they're the ones going out and making this happen. So I wish they were here, but we'd have 65 other people in the room and it would be too crowded. Okay. I know I said we're going to have a Q&A session. Anybody have any questions just about Texas rent relief?
I do.
Yes, Clyde.
Are those all rents that are over 90 days?
Oh, their rents from February, as far back as February 13th, 2020. So anybody that owed us money for any reason, okay, this has been building up. It'll make a little more sense to you, Clyde, on my next slide, because remember, for a good number of months, in fact, the better part of a year, we could not remove people for paying rent. You remember why? So normally, Clyde, we would never let them go. Hey, you owe us that money. What's going on here? But the federal government and its wisdom and the courts decided we didn't have a say-so in that. So, yes, Steve.
Is that money for future months?
Some of that is for future months. Some of this could be for next month or even the next month. Probably not going to go past September at this point because this is just money that came in on the last string. The reason we're expecting another 150 to 250,000 is because now we are applying for 3 more months in advance. So, yes.
What percentage do you think that you got back versus what was owed?
I'm going to say roughly 60%. And here's kind of the dichotomy of this. Great question. Some people would say, well, why didn't you get it all? Keep in mind that we did not know. We had no way of knowing that the government was going to come and give us money at some point. If those of you who are following our monthly narratives, if you remember back in July, August, September time frame of 2020, we had this great idea. Because we're afraid we're never going to get any of the money, we went to every resident and said, you know what? Give us half of it. We'll forgive half your debt. But we want some income. Quite a few people took us up on that.
Brookside was the biggest.
Yeah, Brookside was the biggest. A lot of people took us up on that, and we were happy about it at the time. In retrospect, had I known I could wait another 6 months and they were going to give money, I might have been better off just waiting and getting the rest of it. However, part of the agreement was for to forgive them of the debt. Get out. I'll forgive your debt, but you need to leave so that I can have the unit to turn. So I'm not sorry about it because we then had the units that we could turn and get better renters in there. So anyway, thanks to the staff. Yes?
So basically, like, let's say somebody's lease is up like last September, and you said, we don't want you back in here because your lease is up. They left, you never got to track it down to get your rent.
That's exactly right. If we got half the money, well, here's the first thing to remember that I should have told you. We cannot apply on anybody's behalf unless they're still a resident. So if they moved out or we found a way to get them out, and Vicki's going to talk a little bit about this later, creative ways that we use to get people out. Remember, the moratorium said we cannot remove people for non-payment of rent. Didn't say you can't remove people. So, anyway. All right, I'm going to ask Vicki. I'm sorry. No, yes?
What about Villa Creek? Did we get anything on that, or is that just because it's gone?
We did. Go ahead.
Villa Creek closed out at 0.
Almost nothing to answer your question, Darwin, and that's because
Online question.
eight of the 12 months during COVID, Villa Creek and Diana, our manager, closed out at 0. Again, just kudos to her through that process. What's that?
They got more money? They got a lot of money already?
Yeah. Okay, I'm going to ask Vicki to come up and talk about this a little bit. Vicki, let me give you a microphone so they can all hear you. And again, the intention of this is just to kind of remind everybody real quickly on what the eviction moratorium is and then the CD eviction moratorium and how it's kind of morphed ever since it was put in place in March 2020. So Vicki Skidmore, everybody.
Hi, everybody. Okay, so the eviction moratorium, the CARES Act, that was the first one that came out, and it came out back in March of 2020. So when that one came out, everybody was kind of freaking out because we were like, we cannot file eviction for non-payment of rent. So we had to start getting creative. We started evicting people for lease violations. We started really hounding people for not cleaning up their patios and lease violations, and then we would file eviction. Holdovers, people whose leases ended, but yet they refused to move out, we were able to file eviction on them and get them out. And we were winning these cases. So we even went so far as to hire attorneys to help us get people out when judges were giving us problems and pushback on trying to get people out for other things besides non-payment of rent. The CDC Eviction Moratorium, of course, that one started September 4th, 2020 and went through December 31st. We thought it was going to be over. We were crossing our fingers, and then they extended it through January 31st, and then they extended it through March, and then they extended it again. The final extension that just now came out, it's supposed to end October 3rd. We can still file eviction for anything besides non-payment of rent, even if they don't qualify based on the CDC moratorium, the 5 things that they have to prove up that they've done, trying to get assistance, trying to, all the 5 things that was on that form. Even if we can prove that they have not done it, the judges are still pushing back saying, we're not following through with this. So we're still having some issues with filing evictions, but we are trying to get around it in certain ways.
Tell them really quickly that it's not only the federal eviction moratorium and the CDC eviction moratorium, but there are different municipalities and or counties that have their own moratoriums in place. Just tell them about Dallas, for example.
The city of Dallas, we have 2 properties in the city of Dallas. If it's a federally backed loan, which is 1 property that's in the city of Dallas, you have to provide a 24-hour notice to them prior to giving them the 30-day notice.
Or 21-day notice, sorry.
Yeah, the 21-day notice
Right.
prior to the 30-day notice. So you're looking at almost 60 days before we can even go and file eviction on that person. And that is still put into place until the CDC eviction moratorium goes away.
And really all this is intended to do, just kind of remind everybody what's out there. Obviously we'd love to move forward with every eviction that we need to move forward with, but this is, this is not a political joke, but one of our leaders of this country went on TV and he said, come on, man. Oh, I didn't give it away, did I? I'm sorry. Come on, man. He said, I'm talking to all citizens out there. This is the final extension. No more. Okay. 4 days later, it was extended again to October 3rd. So we fully expect, I'll be honest with you, we fully expect this to be extended again and probably at least through the end of the year. So we do not anticipate that this is something that's going to go away. But I'll tell you, be honest with you, it certainly was an issue in 2020, Tracy. It was an issue. It's really not a big issue for us anymore. Our courts, in case you don't know, the Texas Supreme Court has already told the judges of Texas, you do not have to listen to the federal government. You do not have to listen to the CDC. We in Texas don't do business that way. Now, it's up to the individual judges as to whether they're going to listen to the Texas Supreme Court or not. Most of them do, and most of them have already been allowing us to evict people. They understand. So for the most part, this really doesn't mean anything. We do have 1 judge in Arlington, and we have 1 judge in Dallas. If any of you live in those municipalities and want to help me put pressure on them, let me know after and I'll give you their name. You can run against them. But they're just, as long as this is in place, don't bother calling us. Don't send paperwork, don't sign up. We're gonna, I'm just telling you right now, you can waste your time if you want to, but we're gonna err on the side of the renter. The government's gonna make you whole. Sure, when? I don't know. And as Vicki was saying, normally we give a 3-day notice if we're gonna evict somebody. In the city of Dallas, you have to give a 21-day notice. Heads up, in 21 days, if you don't prove to me that you've been affected by COVID, I'm then going to give you a 30-day notice that I'm going to intend to evict you, which will then take the court 30 days to process. So when Vicki talks 60 days, it's really more like 90 days before we can really do anything about it. But again, this is not really a big deal for us anymore. We just kind of wanted to let you know what was going on out there and kind of what led to all of that Texas rent relief money building up. Any questions about the CDC moratorium or the eviction moratorium at all? Vicki did an excellent job. They've got no questions. Okay. Good. All right. Okay, one of the things that we pride ourselves on, and I'm talking about from a DGRE standpoint and a Door Corp standpoint, one of the things we pride ourselves on is that you as a partner, you as an investor, there's nothing you don't know. If you're coming to these meetings, if you're online, if you're getting your monthly emails, you're getting a brief narrative that tells you what's going on with the properties. But as Darwin likes to say, good, bad, and ugly, I'm just telling you, we're going to tell you everything. I mean, the check register is on the report. I'm not saying you want to read all 156 pages, but you certainly can if you would like to. Nikolai does. Where'd Nikolai go?
Right there.
There he is. Nikolai goes through every check. No. Having said that, I want to give Dillard some kudos because, again, it's not from a culture standpoint from DARCorp and a culture standpoint from DGRE. We just feel like the most important job we have is to keep you updated on what's going on. So I'm going to ask Dillard to use the microphone and talk a little bit about, just kind of give you an idea of what it takes. And the thing he's not going to tell you, so I'm going to start off telling you because he's not a woe is me type guy, is, well, we get toward the end of the month, everything's kind of put to bed. I get to go back and kind of finalize everything. Everybody kind of, and then what happens, Dillard? No, what happens the next day or the next 2 days? Then the first comes of the next month. And guess what? We start the process all over again. This is a monthly process. It is, I'm not going to take Dillard's thunder. So Dillard, would you please stand up and talk to him about kind of what the process is to make sure that all of this happens? Please.
All righty, I'll give it a try. First off, the slide. These are the reports that are contained in the monthly reporting package that goes out to investors. In addition to that, there's a supplemental package that I prepare that goes out to Brian and Brian. Darwin gets a copy. The managers and regionals, if they want a copy, one's prepared for each property. And what it does, what I try to do, I'm halfway decent in Excel, is to take the raw data coming out of the Resman reports and graph some of the stuff out, use conditional formatting to highlight some stuff, and just basically try to turn the really dry reports into something that you don't have to hunt for. Something if there's something interesting about that particular chart or graph, it'll pop out at you, and you can see, for example, how many of you instantly how many of your receivables are 90 days past due, or whatever it may be. But I'm not going to go over each one of these individually. If you have any questions about any of them, I can certainly address them. The process that we go through to generate this package is, as Brian indicated, it's a never-ending process. The first thing that happens for the first week of the month, I'm busy doing bank reconciliations, making sure that the bank account. Hello, Chuck. Making sure that the bank accounts are, for all the properties, are reconciled. I haven't counted how many bank accounts that we have, but how many properties do we have? 15, 16, 19?
Oh, that you're doing package for? I'm sorry. 16.
16, so there's an excess of 30 accounts at those 16 properties that all require monthly bank reconciliation. And we try to keep it as clean as possible during the month, but nonetheless, there are still some transactions that need to be reviewed, identified, and appropriately classified as we're doing the bank reconciliations. And Vicki plays a really big part in that, because I send the stuff to her, and then she gets on manager and says, "This deposit isn't recorded. Where is it?" Or, "How come you don't have these debit card transactions in?" and stuff like that. I'm probably going to bore you with all this stuff. I know it's accounting stuff that's really boring, but it's what I do, and it's what Brian asked me to talk to you about. So then, after we get the bank recs done, then the next week of the month is when I start doing financial reviews of each property, and Vicki is still involved in that. And basically, I won't get too terribly involved in that. Our process basically is that the manager releases, when the manager feels that all his or her entries are in for the month, he or she notifies Vicki, and Vicki looks at the financial statements, and she makes corrections, maybe asks the manager for some more information about some stuff. Then she releases it to me. Then I do my review, and I play around with it for a while. Then I compile a package and I ship it off to Brian. Brian does his review. He may ask a question or two. He rarely does, because by the time the two of us have looked at it, it's usually pretty clean. But occasionally he does have a question, and we'll address that. Then after Brian sends it back to me and says this is good to go, then I send it off to Brian Johnson. Brian Johnson looks at it, and only after all of that happens do y'all get a financial reporting package for the month. And so we think we have a pretty good process between everybody looking at it. After all that, after all the packages are done, then Brian sits down, or maybe he does this while he's looking at them. I don't know, but there's some cash flow schedules that I prepare. Brian looks at the schedules, and that's how he determines how much money we're going to pass out to you guys, and me too, and Brian too, and everybody in the room each month. We try to. I won't even go into what criteria Brian uses to evaluate who gets the distributions, but I do know we try to keep it pretty constant. at the properties. We don't want to certainly don't want to take it down once we've established a certain level, but we don't want to take it up too quickly and run the risk of not having enough money on the property at some point in the future. So it's a balancing act. Brian looks at the numbers and he comes up with the numbers. Then he tells both me and Brian Johnson how much money we're going to pass out, and Brian's got to run it through this IMS software that I'm sure y'all are familiar with to generate the individual amounts. Because if I just did it based on percentages, because the IMS numbers are used to generate the ACH amounts, those have to tie exactly. And I mean, I could fudge, I could play around with pennies on checks, but I can't play around with pennies on ACHs. So Brian has to send me the information for each individual check. It's all broken down, and I load it into Resman, record the entries. The ACHs go out. I prepare the checks. The checks go off to the managers for printing, and eventually there. So that's the process for that. One thing I would like to address, as long as I've got the mic here,
You do?
because I get questions about it every now and then. It's one of the big things I think about all the time, pretty frequently. It's property taxes. Property taxes just take a tremendous bite out of investor returns. I invite any of you to go pick out the DCAD website or the Tarrant County Appraisal District website, even Denton County. You can go back and you can look at the appraised valuations for any particular property over 5, 10, 15 years, whatever it may be. Just go there and look at the valuation increase on some of these properties over the last 5 years and use that as a rough proxy for the increase in taxes over the years. So it's real important to us, to me in particular, to make sure that our property tax numbers every month are good. So the questions I get are, why do the numbers bounce around a little bit? And I'll tell you the process. At the start of the year, Brian Johnson will say, well, we don't know what it's going to be. Let's just assume a 10% increase across the board. And I think that's what we did this year, was 10%. So at that point, in January, I'll take last year's tax bill, multiply it by 1.1 to get 10% more, divide it by 12, and that's the amount of expense I'm going to recognize in January. This will go on for a couple of months, and then in mid-April, the initial valuations hit. And so I'll go into the TAD or the DCAD or whatever website, I look up the valuation, and I change my valuation, and I adjust my accrual accordingly. Then, after maybe a month or two, Brian Johnson will send me an email saying, well, our tax protest people, Alliance Tax Advisors, these are the target values that they think we're going to hit. And I'll adjust the number again. And there it will remain until the appeal, a month or two later. If the appeal results in a change in value, I'll adjust it then. The final adjustment occurs in September or October when tax rates are set. And at that point, from there to the end of the year, it's pretty even. But the object behind this entire exercise is to make sure that at any given point in time, the property tax expense that I'm recording each month is going to wind up, it's the best number I can get for that month. And we do that. I'll tell you a little story from personal experience. I'm invested in some other properties as well as some properties with Darwin from several years ago. And I looked at one recently, and I noticed the water bill was missing. There was zero in the water expense for the month. And for those of you who don't look at this stuff very often, your three biggest expenses on the property are property taxes, water, and payroll. And then I looked, and this was the December T12, and we'd been floating along, and I don't know what the number was. Say it's $15,000 a month for income taxes. For property taxes. And then in December, all of a sudden, there's $95,000. I emailed the guy and said, what happened? Well, that was the amount of the tax bill. They've been under accruing, had not taken into account the things that I take into account, had been under accruing every month for the entire year. And I said, you do realize that between your missing water bill here, your doubled water bill here, and your property tax expense out here, I can't look at this T12 and tell you anything about how this property is performing. He says, yeah, I know. And he changed management companies 2 months later. Okay, that's I'm using this.
Any questions in
any
regards to the
questions?
financial distribution process?
Ben.
When you're refinancing or selling a property, is there anything different in your process you do in the trailing three in preparation for sale or refinance?
Here's my philosophy about recording transactions. I put them where I think they ought to be. When people are trying to refinance or sell a property, the people making decisions above my pay grade may decide that some things really aren't where I think they ought to be. They really ought to be somewhere else. And so at that point in time, yeah, some of the entries may deviate from what I would think they would want to be, but that's their call and not mine.
To kind of expand on that, Ben's trying to set me up here. It's not that we're playing with the books. It's just there are some places you might put it as an expense below the line as opposed to above the line. You're still recording the expense. You're not playing funny money with anything. Thanks, Ben, for setting us up for that. We want to make it look as good an investment. We're trying to sell it to somebody else on your behalf, make it look as good as it possibly can. We want to get every penny we can for you. So that's what Dillard's saying. In regard, I just want to expand a little bit on the distribution process. Thank you, Dillard, by the way. We're very fortunate to have Dillard. We're very fortunate to have Vicki. But Dillard doesn't let anything slide. If you don't do your stuff right, Dillard's on, hey, what's going on here? You got a day. Come on, let's get it done. I got to get it out to the partners and the investors. In regards to the distributions, he is right. I make that decision, but it's not just a stick a finger in the wind. Again, he's building me all of these supplemental reports. I can tell you what the cash flow is on any property. I can tell you what it's been for the last 3 months, 6 months, 12 months. I can tell you everything because of the beautiful reports that he provides to me. And what we're trying to do is simply say that the excess money that the property has for that month, that's not my money. That's your money. That goes back to you. How much of that can I give back to you? Now, do we want to give back every dime, every penny? No, that wouldn't be smart. You never know what's going to happen. Winter Storm Uri. You never know what's going to happen, COVID. You just never know what's going to happen. So I typically look at it in somewhere between 2/3 and 3/4 of the money that we made, the net income for the previous month is what we distribute. You'll also notice that your checks don't deviate, right? I mean, we're trying to set an amount that we think is sustainable so that the only time we're changing it is when we want to go up with it, okay? Then it's sustainable. Then we may go up again, and every once in a while we may do a bonus distribution. Okay, but that's kind of to answer your question about distribution. I'm also going to put a plug in here for my investor relations team, our investor relations team. Julian and Garrett would love if I say this. If you are still getting a paper check, we're glad to continue to do that. But I can't tell you how many checks we rerun every month because, believe it or not, there are some of our partners and investors, not anybody in this room, that hadn't cashed checks in 6 months. I don't know, sticking it in a drawer, whatever. We got some going back to 2019 that have not yet been cashed. These are checks, money that we're trying to give that have not been cashed. So it is kind of an accounting nightmare to keep track of that. And hey, don't you want your money? And would you please, we were talking about Villa Creek today. We have a couple of partners who haven't cashed some Villa Creek checks yet. Well, guess what? We're fixing to close that account in about another month, 30 days. We really want you to cash that check. Please cash that check. Okay? But we would love it if everybody got on ACH. I know, direct deposit, some people don't like to do it. You don't have to do online banking to get ACH, but if you'll touch base with Julian and or Garrett, we'll be glad to do that. In all honesty, when did we start? We're really with Frankfurt Station, it's almost mandatory, right? If you're going to be an investor, we'd just love to set you up on invest. But if you're still getting checks and you want to go ACH, all you got to do is tell us and we'll be glad to do that. And it'll save us a lot on postage and stamps. I know some people still like that tactile feeling of going out and getting 9 checks in their mailbox. It is a good feeling, but you can print out a bank statement and rub it together. It feels the same way. It feels the same way. Okay, last thing that I'm going to talk about here real quickly. I just want to give you an update. I've told you that the winter storm now has a name. It is Uri. That's what the insurance people have named it. This is not, I'm not having a discussion about the effectiveness of insurance. If you're an insurance agent online, if you're an insurance agent in the room, my apologies up front. But there's no question that they're in the 3D business, right? Deferred, delayed, deny, or any of those orders. Just to give you an idea, we have roughly about $1 million, somewhere between $900,000 and $1 million in claims because of Winter Storm Uri. Kind of the good news is, not necessarily for this property, but about almost $600,000 of that's from one property, okay, that didn't have power for over a week. And everything broke and froze and flooded and whatever the case may be. Really what I just kind of want to give you an idea is that almost all of the work has already been completed. So we've already paid for almost all of these repairs. But today, we've only got about $50,000 back from the insurance company, okay? Again, just a little bit of a, this is my kind of way of backhanded slap to the insurance industry. I don't mean it negative. But we knew this was going to be an issue, okay? When we reported all of the storms and we reported all the properties, you don't have to be real specific on night one because we're out vacuuming up water. We're out putting duct tape around pipes and hoping it stays, and we're out flashlights looking for, survivors and what have you. I mean, that's literally what we're doing. But we report it to the insurance industry. Hey, we're going to have a problem with this property. Just want to make you aware of it. They told us, you know what? We're your partner. We're your friend. You go do what you have to do. You got a business to run. You go take care of your customers. You go take care of your clients. You go take care of your property. You do what you have to do. We're short on adjusters. We're short on all of our manpower and staff. And everybody in Texas has got a problem. We'll get to you. But you know what? You do what you got to do. We're not going to fight you on it. Thank you. Did anybody have to clear their throat there? Anybody have to clear their throat? I'll say this. They have been very cooperative in discussing the matter. I can't say it's been real cooperative in forthcoming with any agreements. To date, of the properties that we have filed a claim, which is almost all of them, simply because all of our properties did not have significant damage. Some of them were $1,200 at a property, $2,400 at a property. And you might think, well, why'd you bother filing a claim? That's lower than your deductible amount, right? Here's what we found out. Winter Storm Uri is considered a single event. That means all of your properties that are on the same policy, and we have 7 properties on the same policy, one deductible for all of them. Hey, amen, another great thing for us. But the point I'm trying to make is, of all of those that almost all of the work has been completed with the exception of the 2 units at Riverbend, 2 units at 1019, and 5 units at Gold Creek are still kind of waiting to be done that we're working on. But we've only received about $50,000 in proceeds because our friend, our partner, will do what's right by you, we'll stand by you. And again, I'm not saying they're not going to, it's just been pulling teeth, everything. I mean, our managers, our corporate staff, yes, that includes Vicki and Dillard out on Sunday afternoon at Oakview, helping us go through every single apartment. And, okay, is anybody flooding? Okay, break out the shop vac, let's get it out. Again, all of us going through the properties. But the point I'm trying to make is that, yes, we're reporting this. We're doing the best we can, but that's been, winter storms, what now? We're 6 months past this. And we have gotten a settlement on one property. One property. That's it. We're still discussing, Reinhardt. Still discussing. But the point I was trying to make is that our managers were out there with an iPad and their phone. Okay, well, I've got to fix this 2x2 square of sheetrock. Take a picture of the sheetrock first. Take a video of somebody cutting it out. Take a picture of the pipe that's leaking behind it. Take a picture of them putting it back and taping and bedding it, and then what it looks like at the end to justify all of our expenses. We didn't leave anything stone unturned. And they're still our friends, our partners. Okay, well, are you sure that was at that property? Yes, it was at that. I didn't make the whole because I didn't have anything to do. It was busy. Anyway, just real quickly on Winter Storm Uri is that, again, we've got probably somewhere between $900,000 and $1 million in claims, and today we've been reimbursed as of today for about $50,000 of that. But almost all of that work, all but about $400,000 of that has already been completed. So, okay, any questions about Winter Storm Uri? Darwin?
What about the cost changes in insurance?
I got another slide for that. Yes, Nikolai.
Is it the same insurance company or you have different companies?
We have, is it the same insurance company or do you have the same insurance company for all properties? We do have different insurance companies depending on the property.
And they will behave.
There are 7 of them that are on the same policy, and then there are another 4 of them, I believe, 4 or 5, that with the same insurance company but on individual policies, because some properties have to be on individual properties. Again, I don't want to bore you with that, but Riverbend's an example. It has to be on its own insurance policy. Because of the fire we had in 2017, If you put it on with the property, if you put it on with the rest of the properties, the premium goes up for the rest of the properties. We segregate it, and it's less. Anyway, I'll be glad to answer any of those questions after the fact. And to Darwin's point, he's talking about what it costs. I'm going to get into that here in another slide. In fact, we'll just go to that right now. Let's talk about some of the operational challenges that we're having. I told you a lot of good news tonight, right? This is still, we don't think of this as bad news. It's just challenges that we have to overcome. But we look at them as opportunities to exceed your expectations. How's that? Right, Darwin? That's what I'm telling Darwin. But let's talk about what some of those operational challenges are. And again, kudos to our corporate staff. Really, the rubber meets the road at the managerial level, taking care of it on the properties. But the lingering effects of COVID-19 pandemic. You know what? People don't think about this, but there are more people at home all the time now. What happens when you put more people in one place? What was that? More issues. And it's typically not good issues. They're not all out picnicking together. So, more work orders because everybody's home now. They may have had a little issue with their garbage disposal, which wasn't a big deal when they were only home at night, but now it's a huge deal because I'm home all day long. Again, just small things. We're still going to take care of it, but it's a challenge. Like I said, increased resident interaction. That's my metaphor for people arguing with each other just because they're home all the time now. The federal CDC eviction moratoriums and court rulings, again, I told you it's really not a big deal to us anymore because the Texas judges basically said, we're on your side. Not a big deal, but it is something that we have to live through, and it is kind of a minefield, like Vicki told you. At one property, we have to give a 21-day notice heads up in 30 days. I'm going to give you an eviction notice. I mean, it's just stuff we have to deal with. Ever-changing process for the rental assistance. I hit on this a little bit earlier. I told you that Jessica and our staff did about 3 weeks worth of work, sent it all to Texas. They said, thank you, you guys were proactive. Start over. We don't know if we got what you sent. Start over. Okay. Property staffing. Again, this is probably our number one challenge right now from really from a maintenance staffing issue, right, Anand? Still looking for a maintenance guy at your property? But across the board, and again, this is not a political statement, I'm just giving you the facts. Property staffing, with the unemployment benefits, the child tax credit advance, the stimulus checks, et cetera, et cetera, et cetera, the ability to hire qualified personnel has been made very difficult, okay? Pushing payroll costs up. In order to get good people to work on the property, and that's certainly what you want, there are a lot fewer of them that are willing to come and work in the market. There's just too much money being given to people to sit on the sidelines. We have people all the time. I make more money sitting at home. When it runs out, give me a call.
And people that are on unemployment, they have to prove up that they're looking for jobs. So we'll set up 10 interviews and one person will show up.
Yeah. It's just, and again, is this something we can't overcome? No. But it's just it's an example of kind of some of the operational challenges. Escalating taxes and insurance costs. Dillard hit on this, but it's just, Julian, would you participate with me for a minute? When you underwrite a property, say a year ago, what would you have set aside per door for insurance costs?
About 400.
What would you set aside today?
Between 500 to 600.
33% increase? Yeah, sorry. Yeah, I mean, again, even our underwriting process got to account for about a 30 to 35% increase now in the cost. How about insurance? Dillard, Darwin, you want to share some numbers with us when you're underwriting all these properties out there? Tell us what insurance is doing.
Well, I just gave you those numbers from 400 to now 500 to 600.
Oh, I'm sorry. How about taxes? I'm sorry.
Oh,
Property taxes.
Well, taxes, that's a little bit harder because that's really based on what you're what you're expecting to pay for the property.
Yep.
And for the last few years, the tax rate has not changed. What has changed is the assessed value. Although I don't know if you guys got postcards, but all the appraisal districts started pushing out postcards the last couple of weeks saying, this time around, the tax rate's changing. So, and it's not going to go down. It's going to go up. And so, yes, we always are underwriting at a very conservative 90% of expected acquisition price.
Does anybody know why we expect them to go up? I mean, what do you think? What has happened over the last year and a half or so?
The values have
To municipal,
skyrocketed.
well, but even not only have values skyrocketed, what are cities and municipalities trying to make up for? Yeah. Guess what happened? Sales taxes were way down. You know, all across the board, revenue for the city or your taxing entities, whomever they may be, was down significantly. Guess what? They got to make it up. They got to make their budgets. So anyway, yes, Dillard.
I want to. Am I on? Yeah.
Yep.
Just briefly, I want to mention the way I like to think about property taxes. Most people just look at the property taxes as a line item expense on the income statement. I tend to look at it a little bit differently. Let's say property taxes at a particular property, the ones in the white settlement. I think the initial valuations this year, I haven't kept track with the per unit numbers, but the initial valuations would have resulted in property taxes in excess of $300 per unit per month at those properties. And so you can take the expense line, divide it out per unit to get your per unit cost, but there's another way to look at it, and that is if those numbers are accurate, whatever the number of the eventual property tax bill for the property is on a per door basis is, to take that number divided by 12 to get a per month figure, and that is the amount of rent, assuming your property is 100% occupied, that is the amount of rental income each month per unit that has to be devoted just to pay the tax bill. And like I said, the two properties in white settlement, if the $300 per unit hold, what are our rents there? $1,200, $1,500?
Yeah, $1,200
Yeah.
average.
So you're talking 25%, somewhere around 25% of your revenue is going just to pay the property tax bill. Now, 1019 is a bit different. 1019 is great compared to the others, you know, but across all jurisdictions there's a wide range in values, but that's another way to look at it. And when you start looking at it that way, that number gets even bigger if you're not 100% occupied.
That's Dillard's nice way of saying when we meet on a weekly or monthly basis, oh, by the way, whatever y'all are getting in rent, you need to up it because your property taxes went up and you need another $12 per door. Just to break even, by the way. Okay, ability of supplies. This is what Darwin was talking about, alluding to. Availability of supplies and increase in supply costs. Just give you some examples here. You all know, if any of you are building a house, if you're doing any remodeling, you know what's going on out there. I'll give you just one stat really quick. I was talking to you about the work that still needs to be done from an insurance aspect from Winter Storm Uri. The bids that I collected back and provided to the insurance company back in whatever, March, April, they're no good anymore. All of them have to go back to bid. And guess how long they're good for when they give them back to me? 7 days. Phil hit the head right on the head. The bids are good for 7 days. So I sent it to the insurance company real quick. Hey, you got 7 days. You better let me know because I got to sign this contract. Does anybody believe they're doing it in 7 days? Okay. By the time they get back to me, hold up. I got to call the contractor. Okay, I got a new bid for you. Replacement cost went up. It's good for 7 days. You got to get back. That's kind of the game we're playing here. But that's what the market is doing right now. Appliances. For me to order appliances, and we're doing a lot of this, Ben, at Village Condos, a.k.a. the Brazos. 60-day waiting time. 60-day waiting period. I can get a microwave, but I can't get a refrigerator for 60 days. And oh, by the way, 40% price increase. I used to could buy a microwave, a stove, a refrigerator, and an oven, black. We're not talking stainless steel, black, and put it in there for about $1,500, $1,600. That's $2,700 today. And next week it'll be $2,800. It's just ridiculous what's happening out there. Sheetrock, 3 to 4 week lead time. So, Ben, my apologies that your units are not being turned as fast as we want to turn them. We're on schedule, but I have to anticipate a month from now what we're doing in order to order the stuff and have it ready and available when we think those people are going to move out. Okay? 100% price increase. Anybody going to buy a piece of sheetrock recently? What'd you pay for it? Okay.
Hey, Brian.
Well, 100% price increase, and that's minimum. That was probably a week ago. It's probably 150 to 200 now. Yes, Julian, question.
No, it's not a question. It's a funny story I want to relate. Yesterday, I toured a property that's 100% vacant, and in the process of looking at the units, the guy that was showing us around was telling us how somebody had broken in and stolen some wire because it was the winter storm had happened. And so most of the drywall is off and the wiring is exposed. Well, if you walk up to the building, it is basically plywood, because it's all been boarded up. And then throughout the property, there's stacks of plywood, 4x8 sheets of plywood. And so the contractor said, you know, these guys were in here stealing a little bit of wiring for the copper, and I see thousands upon thousands of dollars a sheet at $78 for a half-inch thick 4x8 sheet of plywood. Plywood that used to be $14 2 years ago.
Yeah.
Outrageous.
Well, I wish that was, you said it was a funny story. I really wish that was funny, but it's, to me, it's not funny. But it is the reality of what we're dealing with. But I appreciate you sharing anyway. You know, paint. Again, it's just across the board. I gave you 3 examples of stuff that we use on an everyday basis. Again, these are just operational challenges. It's not something we can't overcome. But it does affect the decisions that we're making on your behalf as partners. So, Darwin, do you have something you wanted to add? Or would you?
No.
Okay. Well, can I ask you to come up anyway? Any questions about the operational challenges? Again, just in general? If not, I'm going to ask Darwin to make a couple of announcements, and then we'll go into Q&A and answer any questions that you might have about anything. So here's a...
Let's see.
Oh, you got
Can you hear me on the mic? Is that good? First off, now that you've seen the management team, I love Dillard said, oh my God, I see how the sausage is made. I can't believe everything that goes into it. Hopefully you got a little bit of glimpse of how much work and how much management absolutely sucks. Okay, theirs is a 24-hour-a-day job. It's thankless. There's always stuff going on, but we have to have it in-house to control our own destiny. Management is not a profit center for us. We put everything we can into more staff, more employees to make the properties operate better. So if you have third-party management, they're trying to make a profit, and we're not. We just want to make the properties perform as good as possible. And the amount of work that they put in is unbelievable. So please give them a round of applause for the management side.
And I know I said this, but it's really the property staff that does all the work. So
The property staff,
they deserve the credit.
Yeah, the property staff is right there along with them also. Give you some more updates. Brookside is set to close on the 20th. Couple days within there, and then we'll have distributions out. And we usually send out 80–85% immediately, and then close everything out and do the rest. Who's in Brookside? That'll be about a 15% per year average return. Good solid hit. You know, it's not some spectacular home run, but here's the whole thing. Just keep getting those base hits and doubles, and your returns are going to go up and up and up, and your investment grows. So that's one of the nice things.
Sorry, quick question.
Yes, sir.
Is prepayment penalty known already, or it's still?
Prepayment penalty. Let's talk about that. Okay.
The answer is yes.
Here's an area that we had when we put, how do I put this? I'm going to take some blame for something. Okay. Since 2011, when we were, actually 2007, when we started syndicating deals, the debt we would get, I would put in long-term agency debt, non-recourse agency debt. It's assumable. And if you remember what interest rates were back in 2008, 9, 10, if you could get a loan, you were at 5%. Then we were thrilled. We'd get a 4.8, we got a 4.6, we got a 4.5. And we said, let's lock that interest rate in for 10, 12 years, and we would have a prepayment penalty. But I was always concerned that interest rates were going to go up. So I wanted to hedge against that risk. So what we did is we locked that in. There was a prepayment penalty, and locked that in because if interest rates go up, then we've got value in that loan that somebody can assume that loan. Okay, so I tend to be a little too conservative on that. I was a little too conservative, and because of that, we have prepayment penalties on the loans. So on Brookside, for example, we've got a huge prepayment penalty, and that's defeasance is what it's called actually, because we have to, I'm not going to get into all the details. Bottom line, it costs us a whole lot to actually pay off that loan. And that payoff varies based on what the interest rates are doing. They'll go up, they'll go down, they'll go up, they'll go down, and Brian looks at this 3 times a day. Oh, that's going to cost us more. Oh, okay, now we're doing better. And that prepayment penalty is not fixed. What we did do is we bought a cap, okay? So, anybody trade options? Okay, a couple of you. Okay, so bottom line is interest rates here, we bought an insurance policy at this level. So we spent $50,000 buying an insurance policy that said if interest rates go down below that, because every 10 basis points costs us $17,000 more on our loan payoff. So what we did is we said, okay, we'll pay $50,000 for this level, so that way if rates go down below that, because if rates went lower and lower and lower and lower, we could absolutely be screwed on our loan payoff. So we bought that insurance policy there. So it got down to right at the market, okay? And right now it's been fluctuating a little bit above, a little bit below. So we do have a cap on that, so we know that our worst case scenario on the.
It's not set until the closing date. So the actual.
No, our insurance policy has us capped.
But the prepayment penalty is calculated on the closing date.
Prepayment penalty is calculated on the closing date, yes. And when we have to replace that debt, yes. And so if it goes down below that, we still have a cap that it's not going to cost us anymore. So a 15% per year average return on that, which is still pretty dang good in my opinion. Hey, crossing. Okay, crossing. That
It's
one
coming up behind you. It's just it's the drama.
It's slowly
Yeah,
coming up.
There it is. I mean, it's up there.
Okay, good. And that one's set to close on about August 20th also. And the people that were in that ended up with about a 30% per year average return. And that was since 2014 when we bought that. Okay, so again, anything anybody bought since 2012 made a killing. Okay, anything you bought. It doesn't matter what you bought, how you managed it, what you did, you made a killing on it because of owning it that long. Now we're in a market that's been just so aggressive. I'll talk about that for a minute. But first off, crossing set to close, and who's investing in that one? Okay, that one is going to be great. Again, we're paying $8.2 million for it, which is well below the appraisal, just so you know. We've got built-in equity in there, but we need to put over $2 million into it just to keep it rentable, just because of the age. But that should help also our value on creating some added value on that. I want to talk about acquisitions real quick, because Julian and I are scouring everything we can, and the market is just freaking ridiculous. Is anybody trying to buy out there? Okay, yeah, nuts, absolutely nuts. There's a property in Weatherford, okay, if you're familiar with Weatherford, 396 units. We bought Oakview and Gold Creek from the developer. This is the same developer. Oak Creek and Oakview and Gold Creek, get them mixed together. We paid about $135,000 a unit for those two in White Settlement. The one in Weatherford, same builder, same product, but Weatherford, $200,000 a door.
Yeah.
$200,000 a door in Weatherford. Okay.
Not on the highway in Weatherford.
Not on the
Off the
highway
beaten
in
path in
Weatherford, no. And it's even set back from the road that it's on, okay? Now, we had a price in there, we bid, I think, about $180, $185 a door, but $200,000 a door for that property. It barely made sense. I squeezed as much as I can to get to that 185, but somebody else is paying $15,000 a door more for that property. I don't know how they're doing it. One of the models that some people use, and a lot of you invest in them, and they're very successful. Anything you've done, like I said, the last 10 years has been very successful. One of the problems that we have when we, not on this property because it's brand new, is people will buy a property, a 200-unit property, they'll pay $150,000 a door, and they'll budget only upgrading 5%, 10% of the units. So that's all the CapEx they'll raise. so they have a much lower amount of capital to raise, which makes the returns larger. So what they'll do is they'll go in there, fix up those 5–10%, sell it with meat on the bone to the next suspecting victim, and make a killing on it. Now, great business model. I'm not arguing with the business model, but it's not our model because we're not trying to get in there and hold on to it for 6 months or a year and a half. So we go in there fully funding all of the CapEx we need to do, okay? So that hurts us a little bit. Who's heard me preach about exit cap rates? Okay, since most of you haven't, I'm gonna go ahead and preach about it again. That is the single biggest thing when you take a whole spreadsheet, when we're analyzing a property. First thing we do, of course, price and terms and things like that. We go through the income. What is their T3 income? We look at the expenses, analyze the expenses, and then we come up with what we think the rents will be. We look at CoStar, we look at the market, we look at market surveys to say what we can get it to, and if we can improve those units, how much can we raise those rents on it, okay? That's kind of a fixed number, okay? We can't get too aggressive on how much we can raise rents because on that other business model, you can raise rents $200 a door for 5% of the units. You're not gonna be able to do it for all of them, okay? Think about that part of it. So income is kind of fixed. Expenses, we have to underwrite the higher property taxes, the higher insurance. Quick sidebar on insurance. Insurance is scaring the crap out of me. Anybody in the insurance field? That's surprising. Insurance companies, life insurance, insurance companies operate on about a 5% loss on their premiums. Okay, I don't know if you know this or not. Like Nationwide Insurance, they plan on having X amount in premiums and having 5% of that be their claims higher than that number, and they make up for it with their investments. 2008, during that crash, insurance rates went up, not because of claims, but because their investments lost money. You remember 2008-9 insurance rates went up, and you go, why? Well, now I'm scared to death on property tax, on insurance, because the higher cost, well, first off, URI, and second, the higher cost of everything. They are gonna get slammed with claims, and what do? They have to make up for that. So hopefully they can make a lot on their investments so they don't slam us with property insurance. But we go through all the expenses. Those are all kind of fixed numbers. We can't do too much on that. And especially when we're looking at other people's financials, a lot are below the line, you don't see it. And come up with a net operating income. Net operating income divided by a cap rate is a value, right? Well, we look at that, come up with that number. Then we project out 5 years in the exit cap rate. The exit cap rate makes all the difference in the world on whether or not a property makes sense on paper or not, okay? I can make any property look good on paper. Anybody can. But that exit cap rate, we looked at a property that is gorgeous, beautiful on the lake, $250,000 a unit, new construction, absolutely spectacular. How much a unit? $250,000 a unit.
255, yeah.
It doesn't make sense under our normal operating. But if I go in there and I just tweak that exit cap rate a little bit, take it down a little bit, all of a sudden now it makes sense. But who knows where the values are going to be in 5 years, where that cap rate is. Now I said I made a mistake earlier, I was too conservative underwriting, and interest rates just went down and down and down and down and down and down and down. So did cap rates, went down and down and down and down and down. And so because of that, we can't be I still don't want to be too aggressive on those exit cap rates. So any other deal you're looking at, look at what that number is. We still have to be a little bit aggressive. I will say that there's some investment clubs that say use the same going in cap rate on the exit cap rate, okay? So if you're buying something that on these are like a 3.5 cap rate right now, and projecting out 5 years and selling it on a 3.5, do you think that's a smart thing to do? Okay, here's the problem. We do that, we don't have any deals well, when we put it in there, we can't get anything under contract. It's very hard to get something under contract to find that makes sense. But then somebody else will do exactly that, and investors will flock to them. Okay, it annoys the heck out of me, and I worry, and I'm saying, you know what, I look out at you guys are investing a lot of money with us. Everybody online, everybody around the country, they invest a lot of money with us, and I can't sleep at night if I think that we're doing something to put somebody's money at risk. Yet, I know that there are going to be people, okay, I'm going to be really rude, that are going to be dumb enough to go and invest in some of those other things, not understanding the numbers, and they're going to get hurt. And that scares the crap out of me. So I just want you to understand your underwriting on your numbers. Please look at those. Send them over to us. We'll go ahead and give our 2 cents on that, on some questions to ask if you want. But that's making it extremely hard to find anything that makes sense, especially in DFW, Texas in general, because all the money is coming into Texas. Okay? There's a $1 billion fund that just opened up that they were going to buy retail, hospitality, and malls, things like that. They said, those are horrible now. Let's put it all into apartments. So there are big, big players with very low cost of funds that they're fine getting a 6% return over 5 years per year. They're perfectly fine with that. Big, big money can do that. But if we're trying to build wealth for you guys, we can't do that. So let me ask you this. We shoot for a 16% return. I've done this question before, okay? Who would be fine with a 15% per year? 14, 13, 12, 11, 10. There we go, okay, 9, okay, okay.
One other thing, and you can repeat it for those online, on a lot of these other offerings from other groups, they also go out 10 years.
Oh,
Huge.
absolutely. Also, to also make sense of some of these, they went from 3-year analysis to 5-year to 7-year, now to 10 years on looking at those. And projecting out 10 years, what the hell is the world going to look like in 10 years? No idea, but you can make numbers work. So just understand what you're investing in on that part of it. And just let you know, if we don't come out with something, that's why, is because we are still going to stick to our standards on that. We might look for a little bit lower yield, but still keeping that safety net as far as our underwriting, just so that you know we're not going to get too crazy on that. Now, a 2020 build on the lake that's selling at a 3.07 cap rate right now. What I did is I put it as a 3.5 cap rate right now, and then I bumped it up 10 bips a year. So in 5 years, it's only a 4 cap. That is still extremely aggressive, but for a brand new property in an A-class location, that's a possibility. I was looking at trends as far as the cap rates. It was showing cap rates going down and down and down and down, and it projected over the next 5 years just barely going up. Okay, and who knows? Inflation, interest rates should go up, but I don't think that the government can afford to raise interest rates. So I think we're in from some challenging times with expenses and creating returns for people, but we're still going to be looking. Yes, sir.
Are you looking outside of Texas?
We're looking outside of Texas. Yes, we are looking outside of Texas. Question for you. Texas has been the #1 net migration state the last 5 years, at least. One state knocked them off in the last quarter. You know what state that is?
Tennessee.
Tennessee.
Good one, Phil.
Tennessee. Yep, Tennessee knocked them off. No state income tax. So we're looking at Tennessee, not Memphis. I do not want to be in Memphis. Nashville, maybe Chattanooga. Chattanooga's close to Atlanta and close to Huntsville, Alabama. So there's a lot of hub going on there. We're also looking at Florida. We've got, I'm going to do a plug real quick. Jeff, you're probably online. I'm going to do a plug for you. I'm not going to be here for the meeting next month, but I'm going to give you a little preview real quick. I'm sorry, I'm all over the place. We've got an investor. Now, this is a guy, his name is Jeff Young. Jeff has been investing with me for many, 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 many years. He was a good friend of mine. When I first moved to Texas, he was one of the first people I met. And he was in high school at the time, let's put it that way. And now, Jeff has always been weird in one way. He likes all the biology, and he worked for a vet, and he did all the gross stuff with all that. And his job right now is he harvests eyes from dead people. Okay? So let me make sure this is not him calling saying don't say it now. Okay. That's his job. People would pass away. He would have to go talk to the next of kin to get permission to go harvest corneas and all that. He used to do all different body parts. Okay? Now you'd think, because it's in the medical field, it's a very well-paying job. And Jeff, again, I'm sorry if I'm saying something I'm not supposed to. I think he makes about 45 grand a year. Okay? However, his net worth is extremely high from investing in real estate. Okay? One more try? Nope. Okay. Like I said, he's online in Florida. And he's been investing with me for a long time, and he's got a high net worth, and he heard Jeremy talk about his 7-year plan as far as getting out. And he's like, you know what, I've been investing, but I don't have a plan. So he wants to have a plan, and he's going to be doing investor relations for us, and he's going to be looking for properties in Florida. We've already got some partners out there, an attorney that does evictions for apartments, and so a lot of good contacts. And so Julian and Garrett are going to go out there and meet with him and start establishing relationships to possibly buy in Florida. Okay, because everybody likes Florida, right? As far as similar to Texas. So yes, we are looking in other markets, but come hear Jeff next month, because he's going to come and talk about what he did, how he invested, what he's done, and what that plan is. Okay? And I think our next is just Q&A anyway.
Yeah,
So,
just Q&A for the team. So, and this can be about anything.
Anything.
Anything and everything. You know, we talked about operations tonight, but and again, if it's property specific, I would just ask you to. The odds
We'll
are
do that afterward.
Yeah, let's do that afterwards, just so we.
Any questions? Any questions online also, Garrett? Yes, sir.
Let's get a microphone.
Here, I'll
so.
repeat it. Go ahead.
So, a minute ago you're talking about your underwriting
Yes.
and looking at the exit cap rates.
Got it real close.
Hold it real close. Hello. So you were talking about when you're underwriting, you're looking at your exit cap rates 5 years down the road. Rates might do this, whatever. Is that only a problem if you're looking at selling the property in 5 years? Because I heard a smart real estate guru tell me one time, you buy real estate to get rich, buy and hold to get wealthy.
Yeah, and just to reiterate, I've said that 100 times also.
No, I was talking about you.
You get rich buying and selling real estate, you get wealthy buying and owning. Here's the whole thing. I want to be a long-term holder, but I know that a lot of people want to turn and get their money out and go get into another deal. And that's when it's sexy, is when you get that big return, like the crossing buyer, the crossing investors, you know, they can go out at 30% per year return, yay, or Villa Creek at 50%, any one of those things. That's the sexy investment. Everybody loves, oh, I paid $50,000 for this house, and 3 months later I sold it for $100. You know, that's the sexy stuff. We're boring, simple, buy and hold for long-term cash flow. So the big change we want to make sure is whatever we're buying is for cash flow. Okay? We want to make sure we're doing that and holding on to it long-term. Now, if cap rates go up in 5 years, what's funny is even with cap rates going up, I think with inflation, interest rates will go up, cap rates will go up, but then we'll also have higher income, and it all net out fine. So hold it long term. It's like a yo-yo on an escalator. It goes like this and it keeps on going up. The longer you hold, the better off you are. I'd hold on to these things for 50 years if I could. But that's not something everybody wants to sign up for. I mean, we put a 5-year hold in there and people aren't too thrilled about it. Yes, sir.
So can you hold and then refinance, cash out, and pay the investors and just keep the property?
Absolutely, absolutely. We do that. We refinance whenever we can, and that usually is best on the value add properties we've bought. But right now, who's in Frankfurt? Okay, Frankfurt at what did we pay? About 187 a door.
187, yeah.
$187,000 a door. I honestly believe next year. So we paid 38 million.
Yeah, 37 and a half.
$37 million. I think that's a $45 million property next year.
Let's sell it.
No, let's refinance it and pull some cash out. Okay, now we got a bridge loan on that anyway, so we definitely will be refinancing on that one and pulling cash out. But yes, the value gets up, you refinance, you pull cash out. Now, if you do a bridge loan, then we can refinance into agency and we can do one supplemental. After that, we can't do any more. That's why we're selling the crossing, is because we already have a agency debt and a supplemental, so we can't take more money out of that. So we have to recapitalize, sell it to ourselves because it's still a good deal. So that's what we would do if we couldn't refinance. But number one goal is refinance and pull that out.
Darwin, can I share one thing about Frankfurt Station? Just
Yeah.
good news. I don't think I've told you yet. The pro forma for this month was supposed to be right at about 275,000.
Yes.
Vicki, help me with that.
Yes.
What did we actually close the month?
305.
305. Remember. Thank you. Again, the staff.
That's
Remember
them.
when we kind of talked about through this, and you were talking to investor relations, and we talked about it being a 16%. Again, that's still what we advertised, but remember we came back and said, hey, it may be a little bit better because of expectations. Again, staff deserves a lot of credit. But Darwin's already said this. Kind of move your tables, your monthly tables, to the left a little bit because we're already ahead of the game. So congratulations to the Frankfurt Station people. As of today, we're ahead of year 2 pro forma.
Almost at year 3.
Yep.
I think I just felt my
Congratulations.
Killer deal.
Congratulations.
Oh, and on that same note, we are also looking at building also. So we've got a little deal. We've got a conference call to finish up tomorrow on a little 24-unit build deal. And we're looking at some other land to go ahead and build some other things on. So there's the possibility that the next iteration of what we can do is what we'll do is is anybody in Lane's deal? Okay, yeah. Good model. Lane Bean.
Oh, okay. That one in Austin somewhere?
Yeah, down in Leander. Leander is you go through and you put together a partnership, you buy the land, you pay cash, you get all the entitlements done, and then when the construction loan funds, you transfer that ownership into the development. So that's most of your down payment on the build job. And then on the build job, you're looking at about a 20% per year average return. But no cash flow during all the construction until the end. But we are looking at some land deals like that right now to do some building because we've got good relationship with the people that built Frankfurt and a couple other builders that I've been working with for quite a while.
So the full cycle building or just the land development?
He said, so just the full site development or just the land? No, full site is we would buy the land, get it entitled, and then roll that into the full build job. So the equity.
So the end result is the fully functioning apartment building?
So the end result is the full functioning apartment building. But here's an idea. Here's the thing. So you pay $5 million for the land. It gets entitled. That land is now worth $7 million. Let's just say. And then you roll that equity of that $7 million into the build job. So you already made, return on that, and then 20% on that money. So that's a possibility moving forward also.
Darwin?
Yes.
Would that be build and operate or build and sell?
Build and operate. Build and operate. What we do, because that would be a construction loan, and then unless we did a HUD loan, which is a permanent, it's a construction loan to a permanent loan. then there would be the possibility of, after that's done, refinancing and pulling cash out also.
So Darwin, just going on the land deal, is it going to be the point of entry for the investors at the land or in the building point?
The point of entry would be the land.
Gotcha.
And then we would be rolling that in. If we needed additional capital, then we would raise the additional capital. But the people that would benefit from the building the land, buying the land, because after it's entitled, the land is worth more. So then you're rolling that in. And if we need to raise additional capital, then that would come in at that level, not the land value.
Gotcha. Then one follow-up question, just a sidebar. When you're doing land deals, commercial properties tend to give more returns, right? So why would we go for residential properties or multifamily?
Commercial's worth.
Sorry, I
You
messed it
said
up.
commercial is worth more than multifamily.
That's what I heard, right? Like it's probably the same land. If you're using it for commercial purposes, it's going to be a lot more valuable.
I would say no.
Okay.
I think that's why we had the feedback. It disagreed.
He did, yeah, the feedback.
Probably.
I would say no, because we still have a housing shortage, and that's projected to be a problem for at least another 7 years from everybody that I'm listening to. So yes, commercial property could be worth more, but with the vacancy you have, in, especially like office buildings right now, I had a conversation with one of the head guys at Toyota the other day. He was like the fourth guy that moved down to go ahead and get the Frisco operation going. If I'm remembering the conversation right, because of COVID, 90% of the people at that location went working from home, okay? They're anticipating that 50% of the workforce will stay working from home, okay? You work for Toyota? And they said, which is good anyway, because they were already bursting at the seams. But that is this COVID thing, this black swan event, it has changed everything with all the work from home. So just like our properties in Lake Tahoe, it's now turned into a seller's market because everybody said, hey, I can work anywhere with an internet connection, I'm moving out. We're seeing even on the properties that people want amenities more than they want the granite countertops and the stainless steel appliances. They want amenities. They also want bigger apartments so that they can have some space to work in their apartments. So I think the small efficiencies are going to have a little bit of a hard time now because people want to do that. We have executive suites here. Those are all full because people working from the house, I gotta get the heck out of the house. The dog's barking, the kids are running around. I'm trying to be on a Zoom call, so they get executive suites here. So executive suites are going real well as well. And we still are looking at, this office building, which is doing great, was a value add office building. Because if you remember it had mauve tile, gray grout. It was just so 80s. It was ugly, okay? And we did value add. The problem with office versus apartments is office has anywhere between 1 and 5 year leases, so you can't raise the rents immediately like you can on apartments. But if we can find a value add deal like that that has a low occupancy and a higher cap rate, by the way, so you can get better returns, then we're also looking for that type of product also. Yes, sir?
What about self-storage?
What about self-storage is the question. Self-storage is always great, okay? See if you can follow the numbers on self-storage with me real quick, okay? Cost of construction per square foot is half. Expenses per square foot are half. Rent per square foot is the same. Okay, so there's some very good returns in self-storage. It's just finding anything is so tough. You almost have to build it, and then you're going through entitlement, building, and lease up, and everything like that. So we haven't done that either. Yes, sir?
Had a couple questions online. What is your opinion on building new assets, pros and cons?
Pros and cons is construction cost still fluctuates, but if you are looking at the cost today, those are mainly supply chain and employee problems as far as production. Like there's not a timber problem, there's a lumber problem. So, though if you're putting your construction numbers at today's costs, we think that'll be lower over time. So go in there now. If it makes sense, great. If not, then that's fine. So as far as building, I see a value to that because there still is a housing shortage and it still makes sense, but it is very tough to get into, but probably easier than competing with 40 people overbidding on every property for sale. You have to find off-market or deals with a lot of hair on them, like Village Condos in Waco or Village in Dallas.
Got another question. Any plans on having multifamily funds? What are your thoughts on the topic?
Funds, okay. Who's invested in a fund before? You like it? Okay, I'm getting some negative. Okay, I've found that most people want to see what they're investing in. They don't want to put it in a blind fund saying, hey, I'm really great, invest with me, give me your money, and I'm going to go buy something. That does two different things. One is you have a bunch of capital there, you have to buy something. So you might get a little too aggressive on what you're buying because you have to spend the money. That's the problem with the REITs right now, is they've got a ton of money, they have to invest it. If you have a fund and you have a bunch of money, you have to go invest it. And then as investors, you want to see what you're investing in. You don't want to say, you know, I said, I got a great deal. It's, you know, right down in Oak Cliff. It's, you know, and you're saying, no, I don't want to be there. You want to make a decision on what you're investing in, and I think that people prefer that. Any other questions? Sir, ma'am. Okay, the question is accreditation, you know, between being accredited or sophisticated, and what does the property have to do with that and that side of the equation. First off, accredited investors, they make these are rough guidelines. They have $1 million net worth, not including their house or retirement accounts. Okay, that's saying, hey, you have the wherewithal to make enough money to have $1 million, so you're accredited. And or you made $300,000 3 of the last 5 years as a married couple. And what the SEC, this is the SEC's guidelines, because they said here, they don't want to sponsor, they don't want some charlatan coming up here and selling you everybody on this investment, it's great, it's going to make a ton of money, and just get everybody and go out there and broadcast and raise a bunch of money from unsophisticated investors. They're basically saying, look, if you're accredited, then you can make your own decisions. You're smart enough to make your own decisions per the SEC. Okay, but we have two different types, 506B and a 506C. Okay, that's the code under a Securities and Exchange Reg D. And in that, we choose what type of offering we're going to do, okay? Whether it's a 506B or a C. 506B, we can have up to 35 non-accredited investors, okay? So our investor relations team have to keep track. That's why they have the investor IQs, things like that, is we have to look at that and say, are you qualified to invest? And then if you are you an accredited or sophisticated? So we make the decision. It's not up to the property on whether it's a 506B or C. It's up to me as the sponsor. Now on a 506B, I cannot, by allowing sophisticated people in, I cannot advertise that investment. Now if you go on Facebook, you'll see invest in this fund or invest in this, and it'll say accredited investors only. Because if you're advertising, you can only accept accredited investors. So that's all on our side. And the reason we went with accredited on some, where we went that route, is because we thought, let's use this one to advertise. Now, if every one of you would bring 2 new investors every month, they'll all be Bs. But we have to go out there and raise and get additional investors to come in. So in doing that, every once in a while we have to do a 506C so that we can advertise and say, hey, we've got this great investment. And I know a lot of sophisticated but unaccredited investors are like, I'm missing out on that one because I can't be in it. And so I apologize for that, but you know, I think it's about 1 out of every 3 or 4 we do as an accredited only. Okay. Other questions?
We've got one more online. I'll take it if you don't mind. Not that we're going to cut everybody off. Again, we'll stay as long as you want. Just want to be sensitive of everybody's time. But we had an investor online said, I just heard the great news about Frankfurt Station. When can I expect my distribution? Okay. The answer is, and again, I talked a little bit about this before. Yes, I make that decision. Lots of people have some input. But I like to have the property for 3 months.
Yes.
We've only had it for 2 at this point. So give us 1 more month. It lets us, you know, all the work that Dillard does, doing all of that stuff to make sure that everything is correct. We just want to make sure that we have it for at least 90 days. Make sure everything's exactly what we thought it was, expecting it, maybe better, maybe not quite as good. Of course, in this case, it's a lot better. So look for end of September, maybe early October time frame for Frankfurt distribution. I'll promise we won't keep it and hoard the money. We just, again, we want to look out for you and do what's best and protect the asset. So thank you, everybody. I'm sorry.
I think while you're talking about distribution, speak to the crossing, because that's a full-on value-add timeline.
The reason that Julian's bringing this up is that it's important to understand sometimes too the type of investment that we're putting forward and the one that you're investing in. Crossing will be a deep value-add property. Okay, that's not a yield play. That's a value-add property, which means we're going in and basically make, Darwin told you, about $2 million worth of CapEx money to get it up. Okay, that typically, usually a deep value add like that is, again, you've got to run the full cycle to get your leases, your 12-month cycle to get your leases and your units all upgraded, whatever the case may be. So typically, that kind of value add play is somewhere after the 12-month period. I know we set a bad precedent with Riverbend and we started in month 7. That was the exception, not the rule. So just understand, Julian just kind of wanted me to point that out because there is a difference between the value and the yield. Anyway, thank you again for coming. We're thrilled that you're here tonight. Vicki, thank you for joining us tonight. Dillard, thank you. All of our people that are online, thank you for being here. Again, this was really meant just to kind of give you a snapshot, a look behind the scenes at what happens from an operational standpoint on a daily basis and all the work that they're out there doing on a daily basis on your behalf. So thank you again. Last plug for Jeff Young. Join us next month. Darwin's boyhood friend is going to join us and talk about his story and putting his plan together. So again, thank you. And if anybody wants to stay and ask questions, we'll be glad to have you. Thank you.